There we go. There I am. You can't see me in the picture anymore, but just a little bit about me. My name, as I said, is Kelly Katalinas. I'm a branch manager here at Fairway Independent Mortgage. I have been with Fairway for the last 2 years. I've been a branch manager since 2005 and originating loans in the Washington metro area since 1986. So 30-plus years originating loans in the area, and it just tells you a little bit about me. I worked for the big banks for many years, and then 2 years came over to Fairway on the correspondent side and opened a branch here in Fairfax and a satellite office in Woodbridge as well. So I'm experienced in running large teams. I've opened 3 different joint ventures with various real estate companies and builders in the area in the past. And I love to train. I love to work and train realtors and new professionals in our business. And we're going to get into a few things today. So if you'll just bear with me as we go through this presentation, when we talk about a financing workshop, I really want to tell you that I'm going to step into your world a little bit in terms of the real estate professional's role. I'm not a licensed realtor. I work with licensed realtors my whole career, but I'm going to walk a little bit in your shoes with this presentation, and you're going to walk a little bit in mine. So I just kind of want to know that we're going to look at this from a few different sides as we go through the presentation. So for the course benefits, we're going to just talk a little overview. We're going to go through the counseling the seller and benefits to them, assessing the buyer and benefits to them, various loan types, conditional requirements and the appraisal, qualification of the borrower's financing. Like I said, we're just going to touch a bit on that because there's a lot of different programs, so I'm just going to overview on that. The lender approval, the loan costs, and various protections. So first in the overview, the job of the listing or the selling agent obviously consists of many things. And one of the most important things is understanding the financing that's going to be used for the real estate transaction. We want to talk about, first and foremost, the seller, right? What are their expectations? Do they owe more on their mortgage than what the property is worth? Is it a short sale or a regular sale, or are they relocating? You know, all of those have different timetables and approvals that are needed. What kind of property are we working with? Single family home, condo, townhome? What are their past selling experiences? A lot of times that sets the stage for how this transaction might go, or expectations that they have up front for you and me as we're a team in the transaction. Closing cost allotments, you know, if they owe more than the house is worth, they're going to be very concerned about what their costs are associated with the transaction. What's the existing conditions on the property that might need to be addressed to make it more marketable, or that would impact the buyer coming in, or any offer that might come their way? What changes are needed for the house? What are mandatory? What are suggested? And what are the time estimates to sell and close on this property? What do we need? What deadlines do we need to hit here? So in counseling the seller, we're going to look at, you know, what's the loan balance? What is the balance on the loan versus what's the home worth? Understanding the financing. Again, the short sale, regular sale, or is the property in distress? Are we co-oping, you know, with the buyer's agent coming in? Closing costs, repairs, and the overall condition of the property. So another consideration is the appraisal and the offer. You know, is the listing price going to appraise? You know, that's a big issue right now. Things are getting bid up. It's no surprise we're short on inventory, especially in the first-time home buyer ranges. So very concerned, is it going to appraise? Offer considerations, conditional considerations, and then repairs and appraisals and inspections. So we'll touch on a few of these. The loan balance versus the loan home value. As a lender, we engage an appraiser to determine the market value of the property being purchased. Okay, that's way different than a home inspection. We're clearly looking at market value. And we are lending off of the lesser of the two. So there's a contract price and there's an appraised value. We're only going to lend off of what the property is worth. The appraisers will make note of offer considerations. So if the seller is contributing any monies toward the purchaser's closing costs, he will make note or she will make note of that in the appraisal. And that has to be within the parameters of the loan program that the borrower is pursuing. They'll also put in any closing costs or property condition, and it may require repairs or other inspections such as electrical or roofing. So a short sale occurs when the sellers owe more on their mortgages than what the house can sell for in the current market, okay? However, this type of sale has to have approval from the seller's current lenders to grant the sale of the property for less than what is owed. So there's more involved here when the property is a short sale and the sellers are trying to vacate that property. Any purchase offer that is received by that seller has to be approved by the current lenders on the property as acceptable for that transaction to go through. So you definitely want to plan for more time on the transaction because you have to go back and forth between the seller's lender before they can accept a short sale contract. There may also be a second trust on the property. It might not just be a first mortgage. So both lenders would have to agree to the short sale before the contract can proceed. Regular sale is when the seller and the purchaser agree on the sales price. You have a written contract, it's ratified, and it does not need to go through the seller's lender to be approved in order for that property to be sold. So standard sale, regular sale, all parties agree, and the transaction can be consummated. Seller sells the house, all costs are paid for, and all the liens are paid off through the sale. So let's talk a little bit about the seller's financing benefits. A couple of things that our listing agents today need to know, and I'm sure you know a lot of this already, and I'm facilitating this workshop, but let's just touch on a few of them again just so that you might have a little bit more perspective on our side too. There are closing cost limits in terms of what the seller can contribute to the transaction, but there also might be closing cost limits in terms of the seller's ability in terms of costs for what they need to generate out of the sale to move to the next transaction. So they're going to be very concerned about their net proceeds in terms of offers coming to them. We want to avoid any surprise costs, right? We want to be sure that we're speaking very candidly with all parties involved in this transaction in terms of the cost of selling the home as well as what they're going to net out of the property. They want to be sure that the buyer coming to them with an offer is qualified. So hopefully you're counseling any buyers that you're working with to speak with their lender, get pre-approved, and try to submit documentation and get a firm commitment, not just an opinion letter. There are appraisal and lender requirements with respect to the appraisal. You have the down payment and the earnest money deposit security, and always we say beware of the flip. And the flip transaction is a lot of times someone has sold the property, someone buys it, fixes it up, and tries to sell it for far greater value than what it just transferred for maybe 30 days ago. Well, various lending products have some restrictions on that type of flip transaction based on timing. So it really depends on what the buyer transaction is going to be when the flip may or may not be an issue. Usually if the seller is an LLC, you want to be sure you tell your buyer's lender that because there's different things that they're going to have to check on in terms of chain of title when the seller is an LLC.
Se lo mandó.
There's a lot of feedback. Is everybody on, or can you mute your line? As long as you could hear us. Thanks. Okay, so assessing the buyer, we definitely, when working with a buyer, we want to assess their housing budget. How much have they set aside for the monthly payment? We also want to talk to them about the money available to use for the transaction. Sometimes we ask the question as a lender, I'll ask the question, okay, can you tell me how much you've set aside that you want to spend for down payment and closing costs? And tell me what you have set aside in total. Because a lot of times when the borrower has, you know, a lot of reserves, or they have IRAs or 401ks that they truly have no intention to use, that strengthens the transaction. That allows us to speak to that. In that they have shown great capacity to manage money and save, regardless of the fact that they might not want to spend that money for the next transaction. So it does impact in terms of the way we work with loans. We'll always ask, are gift funds available? You know, can they get a gift from a parent or relative? What's their timetable to purchase? Do they have a lease expiring in the next 30 to 60 to 90 days? That impacts some of the rate locks we talk about, how long of a lock they might need and how quickly they might need to move. And first-time buyers, because there are some programs very specifically designed for first-time buyers that may be of benefit to them. And please, please, please always ask if your borrower is a veteran or has veteran benefit. We want to be sure that we discuss that early and up front, because sometimes they might not know about the benefits for VA, which is 100% financing that is available, and we'll go through that. So I always throw that in there. Always ask them if anybody is a veteran and if they have VA benefit. Again, the loan's qualified to pursue, so we evaluate their qualifications to see what they're eligible for. We want to be sure we're looking at homes that are available based upon the loan approval amount. We want to know, do they need to have any of the closing costs paid by the seller? Are we working backwards from the cash available? And you definitely, as a realtor, would want to know that, because they're going to be looking to negotiate for them on behalf of them to help them perhaps with the closing costs. And from the lender's perspective, we try to join, you know, your battle there with them and saying, look, you know, maybe don't lowball your offer. Maybe offer full price, but ask for some closing cost assistance, because that cash is more valuable to you in having the actual cash, because you can pay the payment at the full price. So we talk a lot about that when we ask about available cash and working backwards from the cash. And we try to set the stage for you in terms of that contract negotiation. Granted, they can offer, we know, whatever they want to, but we try to point out the pros and cons of going in at full price and getting the cash and how that benefits them. We go over approval, and then we try to just touch on reaching out to their accountants to talk a little about the tax benefits of home ownership. The buyer and the lender. So I am a loan officer. We help them determine that affordable price range and help them determine which loan is best fit for their circumstances. So there's a lot of questions we ask them up front. They need to understand what the debt-to-income ratio is and what it means, and how their credit report affects them in determining interest rate. We want to be sure that they have enough savings for a home loan. So we really encourage them to get pre-approved up front, but not just an opinion letter. Let us run the credit. Let us get the pay stubs, W-2s, bank statements, and get it validated by an underwriter. So you as their realtor and me as their lender have the most leverage to negotiate for them. And it also allows them to move very quickly. You know, we know these houses are coming up and getting bid on very quickly. We want to give them every single advantage we can in that negotiation process. So definitely the more they know about buying the home, the more capable and confident they are in choosing the right home, and that we've done all the heavy lifting early on in the process. So some of the financing benefits, we want to talk about closing cost assistance. whether that comes from the seller or that comes from a down payment assistance program they might be eligible for. Maybe it comes from gift money from a parent or relative, or even someone who they've had a long-standing relationship with that we can prove that relationship in terms of the gift funds. We definitely want to talk about interest rates, whether they're locking or they're floating, and the pluses and minuses of both of those things. Is the seller going to be taking care of repairs? Are there any conditional requirements or inspection costs? We want to be sure we're setting the stage of that, and we want to be sure we have plenty of time to process the transaction. That's why we definitely encourage them to not just have a conversation with the lender, but actually apply, run a credit report, and hopefully take it a step further with supplying documentation for validation. We want to educate the buyer on their loan choices. We want to detail the costs. And from a lender's perspective, we know that there are some costs that they have to pursue in advance of, a loan estimate. We know that they might have a home inspection cost. We know they might have a radon cost or additional inspection costs that we are not a party to and that are completely optional to them. So you want to be sure you're discussing those costs over and above the cost to purchase. Any contractual requirements in terms of timing and financing contingencies, appraisal contingencies, et cetera. And, promissory notes, earnest money deposits. I know you all know about that. We want to prepare them so that they can close well in advance and no surprises at the end. We want to also prepare them about required inspections, such as the appraisal, versus optional inspections and pros and cons of each. Agency requirements on the property. If they're going with a VA loan or they're going with an FHA loan, there are requirements on those. FHA loans and appraisals have roofing certs, okay? That's part of an FHA appraisal. Termite inspections, are part of VA appraisals. So VA transactions. So, you're going to have different requirements for different loan programs that they go with. And again, beware of the flip, because certain programs you have to have timing requirements met and possibly down payment requirements met if a property has been flipped in a very short timetable. So let's just talk briefly about some loan types, and we're going to just do a high-level overview of some of them here. The Federal Housing Authority program is the FHA program characterized by a 3.5% down payment, and the Federal Housing Authority insures this loan, and you often hear about mortgage insurance premium when talking about an FHA loan. The Veterans Administration allows for 100% financing, and VA loans are guaranteed by the Veterans Administration. You often will hear about a VA funding fee associated with those programs. Conventional programs are often up to 97% financing and typically sold to Fannie Mae or Freddie Mac or a Fannie Mae or Freddie Mac servicer. VHCA conventional loan is a Virginia program through the Virginia Housing Development Authority, and they offer a grant to qualified buyers, and there are no private mortgage insurance options available. Higher rate for that product, but it is doable. And then the VHDA FHA Plus program is an FHA loan funded by the Virginia Housing Development Authority and also allows for some second trust financing to help cover down payment and closing cost assistance on that program. So again, just to highlight the VHDA grant, down payment assistance loans funded by the Virginia Housing Development Authority with a first mortgage. A 203K is actually an FHA renovation loan. This one allows for repairs to the property to be financed into the loan and completed after closing. And there are two types of 203K loans. One is a streamline that allows you to finance basically $30,000 worth of repairs. And then the other is a standard, which you can go higher than that. And you're subject to the FHA limits in the area. And in Northern Virginia, right now, you can go as high as $726,525,000. So it's a good product. Fannie Mae Home Style is a conventional renovation program that allows repairs to the property to be financed into the program. Then you also have seller-held financing. You don't see it too much, but every now and then you might have a seller that's willing to take back the entire note. So there is no lender involved on it. They draw up a deed of trust payable to the seller directly, and it's handled by someone they select to service that loan. And then you have an assumption. So FHA and VA loans are assumable loans, which allows you to sell an existing home that has an FHA or VA loan on it by assumption to a qualified buyer. So if a buyer, let's say if a borrower has a home right now that has an FHA or VA loan on it and it's at 3.5%, well, your seller just got a great selling tool, okay? Let's say the market's at 4.5%, hypothetically. Now they can sell their home on a 3.5% mortgage if you get a qualified buyer to come in and assume those mortgage payments. Those assumptions are handled by the lender in place on the loan, but it gives you an additional marketing tactic that there's financing available if the seller's willing to sell the home by assumption and have the borrower give you the down payment and then take over the current mortgage at the current rate. So it is an interesting way to market the property. Various loan choices here, just so you know, you have conventional financing, and typically it'll say go to 95% financing, but some programs will go to 97% financing. There's all kinds of financing out there right now, but standard, especially for first-time buyers and so forth, you can go to 97% financing to the 484, 350. In the high balance areas, you normally can go to 95% financing, and again, in Northern Virginia, Washington Metro, you're at 726, 525. There are some kind of specialty programs that might let you go with less money down than that, but this is a general kind of guideline for conventional lending. FHA lenders will go to, again, 96.5% loan to value. You have 1.75% mortgage insurance premium that is financed on top of the loan or can be paid in cash, whatever you want to do. And there's monthly mortgage insurance premium on FHA. VA will lend to 100% financing with full entitlement to 726, 525 in this area if the borrower has full eligibility. Has a funding fee for a first-time user of 2.15% that can be financed on top. If they're a repeat user going no money down, it's a 3.3% funding fee. And there are cases where a veteran is exempt from the funding fee. We as lenders will pull their certificate of eligibility through the Veterans Administration portal. And if they are exempt, we can find that out pretty early on. And they would then not have that VA funding fee associated with the loan program. And also, VA is a great jumbo loan alternative because VA honestly has no maximum loan amount. So when the sales prices go in excess of 726, 525, ask the borrower, are you a veteran? Because when we do the calculation, a lot of times they can get in for far less down payment than if they had gone through standard jumbo loans or high balance loans for their financing. First-time home buyer choices, the VHCA FHA Plus will lend up to 101.5% loan to value. So for an eligible borrower under this particular program, you take a 96.5% loan to value on a first mortgage through FHA, and then they provide financing for the second part and can give you the down payment and possibly a little bit more to help cover some of the closing costs. Fannie Mae Home Ready is a 97% loan to value. There's also Freddie Mac Home Possible is a 97% program. Those have income limits that the borrowers have to meet. But they do have expanded ratios, usually up to 50%, and they do have reduced mortgage insurance. So the income limit in the Washington metro area for the 97% in this category is $117,300 combined income in the house, and at least one of them has to be a first-time home buyer. And then grant programs, and those are going to vary from, there's grant programs in counties, there's down payment assistance programs that, you can find through any county. We'll work with you. If anybody is interested in down payment assistance program, just let us know which one. We'll do the research and see what we can couple it with if they're eligible. So again, conditional requirements, you've got appraisal conditions. Who's responsible for fixing the conditions? What does as is mean on an appraisal? And that's pretty self-explanatory. It means the appraised value came in as is. But it also could mean you're selling a property as is, but the lender might not be happy with the as is condition. So that sometimes that can get messy in the negotiating. The inspections, and then the REO versus resale. So REO is a bank-owned. Are we working with a bank or short sale kind of scenario versus the resale where the seller has full control of the transaction. Conditional issues. So repairs are going to be a lender issue if they're safety hazards and the appraiser makes note of them on the appraisal. The repairs need to be corrected before the loan closes. So especially if you have an appraisal come in and say, we have a safety issue, we don't have a handrail in the house, or you have a back deck that's 4 feet off the ground that doesn't have railings, something like that. You will see those come up as issues, and they have to be addressed prior to closing. So any type of safety issue, if the appraiser notates it because they know it's not to code, we're going to have to address it. The agent and buyer must understand the conditional requirements of the loan type they are getting, okay? So down payments and qualifications, we're going to talk about down payment, how much do we have? As a general rule for the debt to income ratio, we use about 45% of the gross monthly income, not net income, gross monthly income. If you have a borrower that gets some tax-free monthly income, we will gross it up. The impact of credit and credit scores on the transaction, and the impact of the credit scores on the interest rate. It not only impacts the interest rate, it impacts if there's private mortgage insurance. So just like you go out and you get car insurance based on your driving record, we give you interest rates and mortgage insurance rates based on your credit score record. We do a preliminary screening or a pre-qualification. You want to recommend that, as I've discussed earlier. If they do an application, for instance, with me online and give me permission to run a credit, that's enough for me to then go through the desktop underwriting system and run that loan through a preliminary underwriting system to see if we can get an automated approval, write a good pre-approval letter for you, and then encourage the customer to then provide the validation of everything they just disclosed on income and assets. So we can do the physical underwriting, issue a hard commitment, and then be able to talk to your listing agent and say, look, we've done everything. We have validated the pay stubs. We have validated the assets. All we need is a contract and a good appraisal, and we're ready to go. And that's what we really try to do. Quality control, it lets us get a lot of the frustration of, having to provide such in-depth documentation out of the way, and let them focus with you on just finding that home of choice, and not worried about the financing going through. We really encourage that, and it just makes for the transaction a much more pleasant one, and it really allows us to move much more quickly. And then loan closing, which of course is what we're striving for. We all want to pass those keys with smiles on our faces all the way around the table. The initial cost preparation for the buyer, the earnest money deposit, I know you're having those conversations about what is appropriate. What's the cost of the inspections? What's recommended? What's required? Insurance, obviously homeowners insurance. If it's a condo, that's a little bit different type of insurance, but insurance is still needed on the contents. Flood insurance. Is the property located in a floodplain? we are going to do a flood certification early on in the process, and we need to tell them, what's the impact of flood insurance if needed? What are the costs of the appraisal and the credit reports that you're paying up front? Because if we're going to order those things, we have to pay those creditors. Closing costs, what comes in at closing, we're going to give them estimates. Down payment, when and how that's handled. The PUD and the condo management letters. This is the bane of our existence some days because they vary so greatly from condo management companies and homeowners associations. We have to get copies of the insurance on the buildings. If it's a condominium, some of those condo questionnaires are running anywhere from $50 to $350. And that's something a lot of borrowers do not plan for. So you need to be upfront with them, especially if it's a condo. If it's a townhome PUD, usually that they're minimal, if anything, on the cost. But sometimes you might have a homeowners association saying, oh, yeah, we'll give you the master policy for the party walls and, the shared amenities within the PUD, but it's going to cost $25 for us to issue that. And that's a cost, to the customer because we can't get the loan cleared without it. So just be aware of that. And I just wanted to touch on one thing here. So and then again, there could be some other things associated with the costs that might come up depending upon the transaction, but that pretty much covers the majority of it in this slide. So the upfront money, the EMD, this is paid when the contract is written, deposited upon contract ratification, and is held in escrow until closing. Estimated home inspection fees, I'm sure you know this better than I do. We've seen them anywhere from $300 to $400 and up. It's paid at the time of the home inspection. Radon, lead paint, roof, any other recommended inspections by the home inspector. And the appraisals typically do start around $495, and they can go up from there. The VA appraisals are a little higher. FHA appraisals are a little higher. And when you get into the jumbo world or you have unique properties, you might see them approach $600, $675, sometimes even higher. Some transactions require 2 appraisals, especially as you move into the jumbo world and you have less than 20% down payments, or the loan sizes go in excess of $1.5 million, you might have the requirement for 2 appraisals. Gift funds are allowed for most down payments. They have to come from a relative or a very close family relationship. As long as we can prove the relationship, sometimes that is fine. Like I said, there's some exceptions apply. That's why I put that in there. Conventional financing now allows for as low as a 3% down payment, and all of it can come from a gift. If it's a single family owner-occupied residence, okay? FHA allows for the entire down payment to be a gift and also allows for all of the closing costs to be a gift as well. Money has to be verified and sourced, okay? So the sourcing is very important, and each program requires a different level of how we source that money from the donor. So please, please, please don't tell your buyer, yeah, just go get a gift and have them just give them the money, because tracking the money is the most frustrating piece of the transaction for anyone. Let us walk them through how that money has to transfer. As long as we get intention, that they say, oh, Kelly, I intend to get a $10,000 gift from my father or mother or both, that's great. We'll get them a gift letter. Just complete the letter and we'll tell you how to move the money later. Some programs do require cash reserves after closing. If they're jumbo products, they will require reserves. A lot of programs don't require reserves. The typical is 2 months of house payments in the bank after closing. But when you move into non-conforming loans or jumbo loans, the reserves can go up anywhere from 1 to 12 to 18 to 24 to 36. It really is a wide variety based on the investor and the type of transaction we're doing. Okay? Agencies will require reserves when you're vacating a property and converting it to a rental property. So expect that you're going to need reserves on the house you're leaving behind and the house that you're buying. Investment property will require a reserve based on the number of homes and loan balances the investor may own. So sometimes we get investors that have 6 properties, 3 of them mortgaged. So you might have a higher number of reserve required after closing because of all of the properties owned. And then the BHDA FHA Plus program is a great program, but it does require that the buyer have 1% of the sales price in the transaction. Initial cost preparation to the seller are repairs, right? We want to talk about, okay, that's a cost to them if they have to do repairs. Cosmetic corrections to make the house more appealing. I'm sure you're going to suggest some things. Inspections, costs to them, and upside down, and are they bringing money to settlement? You know, so those are all the things that we want to prepare them for, obviously, when they're getting their house ready to sell, so that everybody's on the same page with what to expect. Conventional closing cost allotments, and at closing, typically we will allow a 3% seller contribution to closing costs with at least a 3% down payment, 6% concession with 10% or more down payment, and you can include, this concession can be applied to closing costs and prepaid. The buyer cannot profit from the closing costs. It has to be used 100%. If we don't use it, they forego it. So the lender will want to use every dime of it and work with those options that spends all of the contribution. FHA does allow for 6% concession regardless of the down payment, and it can be used for closing costs and prepaid. VHDA allows for a 4% seller concession, and VA allows for 4%, not including closing costs, and an additional 2% for discount points. VA also allows the seller to pay off debts on behalf of the veteran at the closing table. So that's pretty interesting, but can be done as well to benefit the veteran. Again, the veteran can't profit from the closing costs being applied, but he can come to settlement with 0. So he just can't make money on the transaction, nor can anyone else. Closing cost allotments, if it's a conventional investor transaction, the seller can contribute 2% of the sales price toward closing costs. And we want to set proper expectations on time to sell. Obviously, it depends on the market. And closing, you know, can take anywhere from 35 to 45 days. We know they're going faster than that these days because they have to based on the market. But you want to set the proper expectations, whatever it might be, based on the loan program and the seller and the buyer. Protections for the buyer. The sales contract should be completely filled out, signed, and initialed. All issues should be addressed in the contract. Make sure what is asked for from the seller is allowed by the lender. Our point here is it's very disruptive to the relationship. If a buyer is asking for $9,000 in closing costs, but the loan program only allows for $6,000, we have a problem, okay? So you just want to be aware of what those closing cost contribution limits are when you're writing that offer for your buyer so that they match what the seller can do. I'm sorry, what the lender can do. Be in contact with the lender, obviously, and, you know, build a team that you work with and trust. You know, be sure those lines of communication are very clear, and if you have any concerns about the loan program, be in touch with the lender. Protections for the seller, obviously, the seller's subsidy should be reviewed carefully. We want to be sure the contract is complete with the down payment and the loan amount written out. The earnest money deposits are cashable within 5 days of the contract, and again, watch out for the promissory notes or any delayed consideration. The buyer may have qualified at a particular rate in your pre-approval letter, but let's say rates have moved or shifted away. Please be sure that your buyer is still pre-approved based on terms they've locked in at or purchased. So if you have an old pre-approval letter from 2 months ago and the market has worsened, ask your lender to update it for you and be sure they've run it at a higher rate I know I usually work with high rates on pre-approvals just because if the market moves away from us. So if the market's at 4.25 and my borrower can be approved at a rate of 4.5 or 4 5/8, I'll run the pre-approval higher just to protect them for the 60 to 120 days that that credit report is valid in case the market moves against us. And that is all I had for today. I was speaking kind of quickly. I hope I covered everything for everyone, but I really want to thank you for attending. I know Dave wants to thank you as well, and we'll turn it back over to him. And here's all Cindy's information.
Yep.
Go ahead,
and there
Dave.
are a couple of there's a couple of questions, Kelly, that Barbara asked.
Okay.
And I want to make sure that everybody is unmuted as well now, so we can go ahead and you have other questions. But Barbara asked 3 of them. One I need clarification on, so I'll give you the 2 that don't need clarification. She asked, is the $5,000 money available now? $5,000 grant money.
It's not a $5,000 grant. I don't know which program she's talking about. So if there is grant money available, for example, through VHCA, at the time that we do the loan application, we check with VHCA for that availability on grant money, and then we apply for it.
Okay. You know what, Barbara, it looks like you're unmuted. Do you want to go ahead and ask me, because you had a couple of questions you typed in, but I wanted to maybe if you
yeah,
because it sounds like we might need some clarification on some of these. So Barbara, you there? Can you? We can't hear you yet. So so that was one.
And Barbara, you can. Yeah, and if you can't, we can't get it, just reach out to me directly, Barbara. I'm happy to answer it for you.
Yeah. Another question she did ask is if you could give the formula for determining loan to value.
Oh, absolutely. So loan to value is just what is the percent of the loan over the sales price. So in a case of a 80% loan to value, that is a 20% down payment. So the loan amount divided by the sales price is the loan to value ratio. It's just looking at down payment a little bit different. Instead of saying, oh, it's 5% down, you're saying the loan to value is 95% because you're lending 95% of the sales price.
Good. She says, got it. So now, Barbara, I guess I saw got it, but is that to the last question? But no, yeah, she's been communicating with me through the chat box, and she did the way you answered the question about the way you answered the question about the $5,000 grant money. She said that you did answer that for her. So
sounds good. Okay.
But she also asked the question 90 days from the previous sale. And that was with a question mark. So that goes back to early on. Okay, go ahead.
That goes back to flip rules. So you're probably hearing that
got it.
on...
Yes, that's exactly what it is. That's what she said. Yep.
Correct. Mm-hmm. So FHA, you don't want to date a contract until you are beyond 90 days from the date of the last sale. That was now. FHA has been working to try to change some of those things. That's the requirement we've always seen in there from a flip transaction. You have some exceptions on that, especially if it's an REO or it's a distressed property that was bank owned. Sometimes you have some exceptions on that requirement, but generally speaking, if it's an FHA contract, you're not dating it until 90 days from the date of the last sale has expired. I hope that answers.
Good. Yes. Yeah, it does.
Okay.
Oh, good.
All right.
I love the chat box.
One?
Thanks, Barbara. I appreciate you participating with that. So good. Any other questions, you guys? If you want to use the chat box, or if you are unmuted, if you want to just weigh in on it, if you have questions. Anybody else? You have your, Kelly, I guess, do you have a way of making sure I guess we can make sure that we communicate with everybody that just to say, thank you for coming, and then that way they'll have your email. So that way if they do have questions or if they've gone through this and gone, okay, that's
Sure.
something I wanted to follow up. So
sure.
Okay.
Let me just see if I can exit here. Let me go back a second. Are you seeing?
Oh, there we are. Good. Thank
here?
you. Perfect.
Okay.
Yeah. Good. Yeah. Go ahead. Yeah. Click on that and.
Okay.
There we go.
So there you see on the bottom my email address and my website. Please, if you've attended today, just shoot me an email. I'm happy to get anything to you or materials. I would love to know who is on the call because I know I did most of the talking. But yes, do send me an email, and if you have any specific questions, you're working with anything that's complicating, you just want to run it by me, that's fine. Totally fine. I'm here to help you any way I can.
So, good. Excellent. Well, thank you so much for everybody being here today, you guys. I really appreciate it. Again, if you haven't had an opportunity, I would check out the training next week at NVAR in Fairfax. It's actually a week from today, on the 14th. Starts at 10:30, goes to about 1:30. But yeah. Go ahead, Kelly.
Yeah, and then the session here in Fairfax, which is going to be the full version of this presentation, we're going to go a little bit more into detail on qualifying and various programs and so forth. So that's next Thursday from 11 to 1, and it's here at my address, which is 3201 Jermantown Road. And we'll be in Fairfax, 22030, and we'll be up in the penthouse suite. And Cindy has it on her website. So that session, if you're interested, you would just register through Cindy Bishop Worldwide.
Barbara, you asked the date. Oh, so the date for your training, Kelly, is the 16th,
mine is
right?
the 16th. Correct. Thursday the 16th. Good. Correct.
Good. Okay. Awesome.
Thank you guys so much. I really appreciate it, and I really love doing the webinars. I know it's an efficient way to get some information out there, but certainly if you have anything unique and you want to run it by me, I'm here to help you.